So we're back with Cameron Gleeson to join us to talk about smart beta. So Cameron, as I mentioned before, he's the Senior Investment Strategist with Betashares and also sits on the investment committee. And so Cameron, thank you for joining us today.
Thanks, Jill. Great to be here.
So we're going to talk about smart beta.
Mm.
As all of our clients should know by now with being clients for some time, is that our investment philosophy essentially revolves around using index funds as the foundation of our portfolios.
Yeah.
But we have for a while, but it's becoming a bit more of a talking point about the benefit that's having a smart beta fund in the portfolio does. But it's a little bit unknown exactly what they are and what they do. So, Cam, over to you today. First of all, we want to know, what is smart beta
Hmm.
and why do we have it in the portfolio? What is it there
Yeah.
to solve?
I think great question. So, smart beta really is just an evolution of index investing. A smart beta strategy provides a way to invest in markets like Australian shares or global shares beyond what we would call the market capitalization weighted indices. That's the traditional indices you think about, like say the S&P 200 or MSCI World Index. A smart beta it's an index approach. It takes the best parts about index investing. So it's rules based, it's transparent, it's low cost. But rather than investing in, say, the largest companies in an index, in a market, you're looking to invest based on a predefined set of rules in a type of company or a style of investing. So, for example, there might be a smart beta index of quality companies, companies with strong profitability, strong balance sheets, or indeed value companies, companies which are trading cheap relative to the rest of the market. Or you could perhaps have a income smart beta strategy which seeks higher yielding parts of the market. So these are all really interesting ways that you can seek to build a portfolio. And if we're building multi-asset portfolios, these can be really additive to the overall portfolio mix, both in terms of building resilience into the portfolio. There's a lot of concentration in broad global markets these days. So how can we reduce some of that concentration? Or indeed, how can you drive outperformance through providing some exposure which is different to those traditional indices?
Mm. So we talk about a lot with clients about that concentration. I think where, like with the S&P 500, where we've got the Mag 7 or
That's right, yeah.
that, and in times of volatility, that causes a lot of more volatility because a lot of people are invested in those. There's a lot of emotional investing. Is that correct to say?
Yeah,
Whereas there's companies further down that maybe no one's heard of.
yeah.
Aren't impacted so
Yeah, I think a
heavily.
smart beta approach, because it's still a rules-based approach, you take out a lot of the emotion that comes with investing. And that's unfortunately one of the challenges if you are picking individual stocks or indeed even a professional active manager. Dealing with emotions in investing, we tend to find that they can be detrimental to your overall performance. So having that rules-based approach, which is sort of going to prosecute a consistent way of investing in markets, tailoring that exposure and investing in the types of companies that you think are going to drive resilience, or as I said, outperformance, we think is a really strong way to invest. And we still invest in those broad traditional indices we think about, but we think a blend of those indices, which really lowers your cost, together with smart beta can be really complementary.
Yeah. And so, is there, say, quality or value? Do one of them behave better in one market condition than the other? So are they sort of
Yeah,
opposite to each other?
that's spot on, and that's really important to point out. So these investment factors, as they're often called, but smart beta, investment factor, sort of different names for the same thing. What the research and the empirical studies show is that over the long term, they have the ability to outperform. But we're all investors and we have a shorter term horizon than, say, 10 years when we're looking at our portfolio. Each of these factors can go through periods of outperformance and underperformance on the shorter term. And what we have seen over, say, the last 10 or 20 years is that, for example, quality, it will tend to outperform at different parts of the cycle as value, for example. So if we think about how we invest in the portfolio for Australian shares, we hold three smart beta strategies. One is an Australian quality ETF, one is an Australian momentum ETF, and the other one's a value-oriented approach. So we see that all three of these can add performance over the long term, but by blending the three of them, we have less periods of underperformance in the short term. And we think that's really good in terms of controlling the risk ensuring that people have, I guess, a smoother ride when they're investing, not just a strong long-term performance outcome.
You also do smart beta in the fixed income space. So do you want to give us a little insight into what happens in a
Yeah,
smart beta fixed income ETF?
yeah. Look, really important to consider all parts of your portfolio, and fixed income is an area where you can add value through smart beta. In Australia, the standard fixed income index is called the Ausbond Composite Index. Unlike in the share market where we weight basically by companies that perform well, the companies that perform well, they tend to be bigger in market capitalization, so you weight them more in your portfolio. In fixed income, we sort of do the opposite in a way. The Ausbond Composite Index is weighted based on how many bonds have been issued. And so a company that needs more cash, is more indebted, has more bonds on issue, right? It's almost counterintuitive. If you look at the shape of that index over a long period of time, it used to be a really nice balance of corporate bonds that tend to pay you a slightly higher yield or income, with government bonds that provide you equity diversification. But over the last 10 years, that has really skewed to being really almost entirely a government bond index. Now, we think that both the income and the equity defensiveness are important characteristics. And so we worked with Bloomberg, the index provider, to provide a smart beta index, which is used by our Australian Composite Bond ETF, OZBD. And that's providing a better balance of that income and defensiveness in terms of the government bond allocation. It's provided really strong returns over the long term, higher level of yield. And so that's the way you can apply smart beta in fixed income to improve on what's there already.
I just wanted to ask you one more question, and that's around the global smart beta that you use in the portfolio, and that is the equal weighted S&P 500 ETF versus the market cap,
Yeah,
just straight index funds. So do you
yeah,
want to just explain a little bit how just that equal
yep.
weighted strategy can have a benefit?
Yeah, of course, of course. So in Australia, most people think of US equities and they think of the S&P 500. That is the standard market capitalization weighted index. But actually, a lot of investors in the US will also invest in the US S&P 500 equal weight index. Um, you'd think a market capitalization weighted index is the simplest index you could have, but indeed, if you think about an equal weight approach, it's literally taking the same 500 companies and just investing the same amount in each one. So 0.2% in each one adds up to your 100%. It means you have a lower allocation to those magnificent seven names. At each rebalance, you've got about 1.4% in across the seven names. And look, that's really important in terms of shaping your overall portfolio, reducing the concentration risk we see in that index. It also provides a slight value tilt, higher allocations to things like financials, industrials than are represented in that relatively concentrated broad market. So we're basically blending towards a more balanced, we believe, more balanced sector profile. And when we see things on a whole of portfolio basis, that combines really well with our Global Quality Leaders ETF. So this is global quality companies. It blends in higher allocations to profitable companies, companies with resilient balance sheets, and that has a greater allocation to areas like healthcare, which can be more defensive. So again, we're seeking in global equities to blend quality and value, and those ETFs are very, obviously very low cost. So we were able to do this, make sure that the overall management fees of the portfolio are very low, but shape the portfolio such that we have some defensiveness in case we see a correction in perhaps some of the well-known Mag 7 names in the market.
Yeah, that's great. So it's in sense um, veering on an active managed index fund basis. So you're keeping the costs low, but we're still getting a little bit of extra benefit out of
Yeah,
the squeezing it out of the
yeah, yeah.
index.
So we'd sort of say that, look, this is all, ground in empirical studies as to what companies outperform over the long term. We don't take a particular view as to whether, say, quality or value outperform, but we know that by combining them, what data's shown us is that you can get better outcomes over the long term using these rules-based building blocks.
Thanks, Cam. That's really informative. So thanks so much for your time today.
Anytime.
Hope that was interesting for all our clients out there, and want to take this opportunity to wish you all a very Merry Christmas and safe holidays. And we look forward to seeing you and David again next year for some more updates. Thanks so much.